Okay, this video is going to give a brief overview of the accounts and how to account for the sale of merchandise. So in previous chapters, we've been selling services. And when we sold services, our revenue account was called fees earned. Now that we're going to be selling merchandise, we're probably going to call our account sales. And again, the difference is that we're selling stuff that we purchased in order to resell it. All right. We're going to have some new accounts, and we'll talk about those. And we're also going to talk about the importance of first determining if we're the buyer or the seller in each transaction. All right, let's first go through all of the transactions as the buyer, because these are going to have fewer accounts, as you'll see. All right, so the first thing that we're going to do is we're going to purchase inventory. All right, when we do that, we're going to debit merchandise inventory, and we're going to credit either cash or accounts payable. And this is going to be for the purchase of merchandise inventory. All right, and then if we return some inventory, what we will do is the opposite of the above. We'll do either cash or accounts payable, and then we will credit merchandise inventory to show that we no longer have that because we returned it. All right, and this is to return merchandise inventory. All right, and then if we take advantage of a purchase discount, that is a discount that was offered to us if we paid within a certain amount of days. In other words, they'll say 210 net 30. That means if you pay within 10 days, you can take a 2% discount. If not, the entire total is due in 30 days. Okay, so again, that would look like 210 net 30. If you ever see these terms, it means that they're credit terms. It means that either you have not paid yet or you have not yet received the money. And if you're the buyer, then it's up to you if you want to take advantage of that discount. Then that just means that you need to pay within 10 days to take that 2%. If you are offering it to a customer, it's their choice. If they want to pay within 10 days, then you will give them a 2% discount. This is so that you can get your money, entice your customers, and your buyers can entice you to pay sooner. All right, so if you take advantage of a discount, it's going to look like this. You will reduce what you owe, and you will reduce your merchandise inventory because you did not ultimately end up paying that 2% for your merchandise inventory. All right, if you have to pay for freight to get that inventory ready to sell, it's called freight in. And let me go up here and put a description. This is if you take advantage of a purchase discount. Okay, if you had to pay freight to get your merchandise to you, you're going to increase the cost of your merchandise because we want to value that at everything that it cost us to get it ready to sell. And you can either pay cash, or if you did accounts payable for that, pay UPS or whoever you pay. And this is freight in other words, freight charges to get your merchandise in to you. All right, so this is all the buyer. So let me put the word buyer up here so we'll be real clear on that. All right, if you're the seller, we're going to add in some new accounts that we haven't seen before. When we make a sale, we're going to have 4 accounts. The first 2 are going to be your sales price. It's going to look like this. Accounts receivable or cash, depending on whether or not they pay you up front, and sales. That's for the sales price. Part of the same entry is to move your merchandise inventory, out of your asset, and into an account called cost of merchandise sold. This is an expense account. Cost of merchandise sold is the expense. It is the cost that you paid for that merchandise that you are now selling. All right, and then you'll credit merchandise inventory. All right, so let's look and see exactly what this does. The first 2 accounts record your sales price. The next 2 accounts record the movement of that inventory out of the asset and into the expense. Much like any other deferral that you had in the previous chapters, where you held it in an asset until you used it up and then you expensed it, here we held it in an asset until we used it up, or in this case, until we sold it. So the matching principal asked us to hold it in an asset until we sold it. Right here on this entry on this day, we sold it. So we're going to move it out of the asset and we're going to expense it. All right, if a customer returns merchandise to us, we want to keep up with that separately. We don't want to just debit sales. Instead, we want to debit a contra account. So we're going to reverse this entire entry, do the opposite to it if they return it to us. However, instead of debiting sales, we're going to use a contra account. Sales, returns, and allowances. Contra accounts have the opposite balance as the account they are contra to. So this is contra sales. So sales has a credit balance. So this account has a debit balance. That's why we debit it. All right, and then we want to do the opposite to the accounts receivable or cash, whatever it may have been. Then we want to put the merchandise inventory back into our warehouse so we can sell it again. And then we want to credit merchandise sold because that is no longer an expense because it has been returned to us. So this is to record the return of merchandise to us. All right, the other thing that we can have is we can have freight. If we pay the shipping to a customer or for a customer, then we'll have freight expense because this is a selling expense and we want to keep up with it, and cash or accounts payable. So remember on the buyer we added it to the cost of inventory because we wanted to value our inventory, everything it took to get it ready for us. But here this is a selling expense. So we're going to debit a selling expense called freight expense. If we have a discount and our buyer takes advantage of that, then what we're going to do is we're going to have a contra account that's going to reduce sales called sales discount, and we'll reduce cash or accounts receivable. Actually, it won't ever be cash because if you had a cash discount, then by the very nature of it, it was on credit terms, which means they owed you money. So it'll be accounts receivable every time. And you'll usually see this entry right here combined with the receipt of the customer's payment because you will know on the date of payment whether or not they paid you within 10 days. You'll actually do this entry at the same time as you receive their payment. So this is to record the discount taken by our customer. Okay, let's stop here and do a recap. So the first thing that you do when you go to read a transaction is you decide if you're the buyer or the seller. And then you decide what's happening. If you purchase merchandise, I should have started this right over here, shouldn't I? I need more space. Let's see if it fits now. Okay, then you're going to debit merchandise inventory. Okay, if you sell merchandise, then you're going to credit merchandise inventory. If you have a discount and you're the buyer, you're going to reduce merchandise inventory. But if you are the seller, then you're going to use a contra sales account, which will be called sales discount. If there's freight involved, if you're the buyer and you're paying for freight on your merchandise inventory coming in, freight in, you're going to debit merchandise inventory. But if you're the seller, that's a selling expense, and you're going to debit freight expense. If you have a return, if you're the buyer, you're going to credit merchandise inventory. But if you're the seller, you're going to use a contra account called sales, returns, and allowances. All right, so you see here, if you're the buyer, you always use merchandise inventory. If you're the seller, you're going to keep up with it in separate accounts because you want more information related to that. All right, there's going to be a separate video, and it's going to go through and tell you who's going to pay shipping, why, and how. Okay, that's going to be FOB shipping point, FOB destination, and what that's going to entail. Then there's going to be a separate, very short video that will show how to calculate credit terms, such as 210 net 30, when you're both the buyer and the seller, and how to actually do that calculation.